And for more on what to expect from the Fed minutes from a former Fed insider, Vincent Reinhart is a former secretary and economist at the FOMC and the former director of monetary affairs at the central bank. Vincent, welcome back to Bloomberg. So you just heard our preview, our setup from our reporter Scott Landman. So a lot of people are expecting this round of minutes to be a little more interesting than recent rounds, perhaps because we'll learn how many others, if any, agreed with President Honig in dissenting to keep rates low for an extended period language. So, of course, I'm curious if you think what you think will happen with the key language and if you expect any additional dissenters.
So I think Scott pretty much covered the waterfront. There are two key points of dissension within the FOMC. The first one is how soon should they start the process of shrinking their balance sheet, selling those MBS securities, letting some Treasury securities roll off or either sell them outright. And then second, how much longer do they keep with the commitment to keep interest rates low for an extended period. That makes a number of policymakers uncomfortable. And so the minutes will give us a little more information on that. But, you know, relative to most times, the key market event since the FOMC meeting, namely the troubles in Greece, probably make them a little less relevant than they normally are.
Okay, fair enough. So maybe too much buildup before this one. Any policymakers, who are the policymakers that are most likely to have agreed with the position of Honig?
Obviously his colleague central bank presidents, President Plosser, President Fisher, Jeff Lacker. That's probably the crew that, in their hearts, are worried about the size of the balance sheet, are worried about the strong commitment contained in the extended period language, and would want to loosen up the statement some.
Vince, could I ask at this point, we're now in the middle of May, and this obviously reflects last month's minutes of that meeting, any sense that they may have talked about moving up the forecast for economic growth, or is it too soon for that?
So the forecast to me is the most important part of this set of minutes, right. Exactly for the reason you're talking about. They are not in a position to contemplate changing the stance of policy.
Why not?
Until their forecast gives them a reason to. And right now, the unemployment rate is remains high in the forecast, and inflation, if anything, edges lower.
Yeah.
They got dual objectives. Both of them point toward easier policy. Until the objectives point in different directions, at least, they won't be in a position to, to exit from their current stance of policy. So what you should look for is, do they mark up their growth rate forecast, or do they lower their longer run assessment of the economy's potential to produce and raise their estimate of the natural rate of unemployment? They do that, they're positioning themselves to give them a reason to tighten somewhere down the road.
On this question, Vince, of economic forecast, this morning, of course, we learned that core inflation fell to a near 50-year low. How is the Fed looking at that number, and what does it say about where the economy is headed now?
Well, they should look at it with some concern. The fact is the level of inflation, both top line and core, is lower than back in 2003, 2004, when all policymakers were talking about the risk of unwelcome further disinflation. So they've got to be concerned about that. And these inflation readings basically, knock the wind out of the more hawkish members of the FOMC, because they really can't point to anything in particular to give a reason to want to exit from their stance of policy accommodation.
Thank you so much, Vince Reinhart of the American Enterprise Institute. He is the resident scholar there.